Greetings all, been here from East West. I haven't had a look at TLT and the rate market for a little while, so I thought I might just do a quick video here through the week and just check out where we stand since last I took a look at it. So I'm just going to start here. I'm just on the iShares website, and this is something, if you're interested in TLT, that you probably need to do. So what I'm just looking at here is the holdings of the actual ETF. So what they've got on their books. And what we need to keep in mind is that you can see here 8.18% of the book is a 2051 bond. Okay, and then 7% 2051. So you can see as you look at all these maturities that they're very long. This one's a little bit shorter. But when we sort this by maturity, you can see here that the shortest bond they got is November 15, 2042. So as we know, this is a 20-year bond fund, but it does contain a lot of sort of 30-odd year bonds. So the 30-year bond, the T bond, is actually the one that we really need to concentrate, because obviously that is going to have the biggest bearing on the price of TLT. And so as we look at this on the weekly, not much has really changed other than, we were looking at this low here and wondering if that, well, certainly I was wondering if that was going to be the low. And we did have the very clear signs of divergence coming off this bottom here, which sort of alerted us that there was a good chance that this was going to be the low. So is this the low? Well, it's looking more and more likely, isn't it? It's certainly, love it or hate it, we can sort of count 5 waves down here. We're yet to break out of this trend channel, this big trend channel, but that's going to take a little bit of time. So I've drawn your attention to this previously because for me it's still about price getting on the other side of the Ichimoku cloud, and we're not quite there yet. But as things sit, we have reached the Kijinsen, so that represents roughly it's a slower moving midpoint of price. So basically how we read this at the moment is that yes, we've had this good run in price, but it's gone fast in regards to time, and that might mean that it just needs to pause to let the Kijinsen catch up. Now the Tenkan-sen to catch up. So what we would like to see in the near future is the Tenkan-sen, the fast moving line, getting above the Kijinsen, the slower moving line. Okay, that would be what we'd call a TK cross. So that would be another bullish confirmation that the bottom's in, that we're moving on. So a couple of good things have happened here since last we looked at this, and I did pinpoint this low as being important to break through, and now we've done that. So that is obviously a very good thing. So I would now just look at this consolidation zone up the top here that we had, and then I'm just looking at a retracement, because at some stage this will correct somewhat. But these sort of areas up here around this $96, $97, 96, yeah, that would be the sort of area where I think that price would maybe just initially pause and just maybe catch its breath. And as I'm sort of making this video at the moment, which is about midday my time, the bonds themselves look like they're just a little bit tired, and maybe they're a little bit out of gas. I'm talking about in the very short term. So maybe we get a little bit of a correction, but that remains to be seen. However, that would be the kind of area that I would just be looking at initially, just to think, okay, well, have we got something here where the market might pause? So just looking at this on a daily, this was the bear channel that we're in, and now I think the last time I looked at this, we were around about here, and I was sort of just saying, well, we've sort of come through the trend, but we haven't broken it, with a lot of definitive price action. Well, now of course we do have that, and even today we've gapped even further. So just these little sort of daily tops. I mean, this looks like a pretty good one in here, just as a little area to challenge. And then does that tie into the sort of retracement areas that we were looking at? If we just sort of take off this high, then this little area of challenge just lies into that retracement zone. So that might be a little short-term target the market's just trying to get to before it corrects. But we just keep our eye on this, because the RSI is starting to just struggle and bumble away. And that doesn't mean that necessarily that it's going to come off, but what this would represent is the market just starting to lose a bit of velocity, which kind of looks a bit funny the way it's trading because it's still looks super strong. So yeah, I take this with a grain of salt. Actually, I would say this one thing about, and this is the same with any video I do. All this stuff, all these drawings and pretty lines and Elliott wave and all this sort of stuff, it all means nothing. The only thing that really matters is this: where is price now? Price is king, and everything else is irrelevant. And right now, we've got a nice strong candle to close out today, and yeah, we do got a little bit of a gap there that we might need to come back and fill. But we had some gaps here that we've come in and filled. So, you know, the next, it's not really another gap in the market until we sort of come up to here. So maybe that even represents another area that we need to come in and challenge. So just looking at this in a cyclical sense, you know, this is looking more and more like an intermediate cycle low. The fact that we're here now on day 43 would suggest to me that this is not going to be a cycle that fails, okay? And a failure would mean to come down here. But I can't see the market at this stage, you know, coming all the way down here to make a failed cycle. The fact that we're on day 43 means it's more likely to be right translated. So what that would mean is I'd expect the market at some stage will just come down below this 10-day moving average before it moves on again. Okay, but we don't even know if this is the top of the cycle yet. We just watch and see. Now, if you wanted to get into this, I mean, if you're going to be a long-term holder, well, I would suggest that it probably doesn't matter a great deal. But if it was me from a trading perspective, I would now just be thinking about the pullback if and when it comes, and you know, depending on wherever this, just say today was the top, I'd be hoping to see something like that, even though, you know, the way that these form up doesn't make great Elliott on the short-term time frame, but that would be the sort of thing I'd be looking for to initiate some sort of long position. And you know, you can just see how that would just tie into this little bit of congestion that we've had here, because since we sort of broke through this area, it's been pretty much smooth sailing on the way up. Now on the daily Ichimoku, we've had some good developments in so much as we had the Kumu twist here, okay, and this was quite a long downtrend. You know, this lasted quite some time. You know, we on a daily, you know, this cloud from June 23 all the way through, well, this is showing January 24, but of course this is printing 26 days in advance. So this would suggest that we're running a little bit hot. The Tenkan Sen is rising, but we are starting to get quite a big gap away here from the Kaijins. And so at some stage, we're going to want the market to come back into balance like this in terms of those two lines. And this is just more a study of time versus price. And at the moment, it just looks like price has run away from time a little bit. So, you know, I'm not saying that this is going to be the top and that we're going to come down, but I would expect at some stage before too long, we are going to get some sort of retracement back. And whether or not that comes back to test the cloud, and this is the beauty of the system. When you look at this, yeah, see, so maybe we've got a little bit, I mean, ideally you'd like to see that, probably, like the market up to here, and that we can retrace back and just hit this cloud. But of course, in time, we'll probably be somewhere more around here. So, yeah, I mean, as long as we remain above that cloud, that's fine. It just looks like it's running a tad hot, so it might just need a little retracement. But once again, I mean, you could just put the Ichimoku aside, and to me, it would still be about looking for the retracement to try to get long before we go on further. Now, one further sign of heat is we are just breaking above the Bollinger Band. So, I mean, the last time we sort of did this, we came back a little bit. I'm not saying that's going to happen this time, but, you know, it just shows that this is all being dragged quite violently now by price. So, you know, there is a case to be made that before too long, we just need to correct before we can keep going. And I think we will. But, you know, it's just about dealing with just the short term, just what we can see in the short term. And that's how I would be thinking about this now. If I was a long term, sort of looking at it a long term, and, you know, I'm thinking 3 to 5 years, or I'm thinking this is the next cycle, which, remember, hasn't been confirmed yet. This is just people's speculation that the cycle's over. Well, you could just buy here, and maybe you want to put your stop below that, because obviously if we get below there, then something drastic's gone wrong. But, you know, then you would have to decide if that amount of risk is acceptable for you. You know, you would have to maybe position size and work out, you know, if you wanted to stop out below that, well, you'd have to work out how much you're risking and then set your size accordingly. However, I mean, I will say that I think, generally speaking, my view is that, yes, the rate cycle of tightening is almost certainly over, and that this is a pretty good launch pad. But like I said, I think tactically you just want to see that's what you'd be looking for before you get long. So we're just looking at the 30-year bond here on a yield basis on a weekly, and this is basically the general premise of how the count's gone, and that we have topped out here for 5 waves. What do we get to? Just shy of 5.2%. And at the moment, I mean, the way it's reacting away, I mean, that looks pretty good, right? Now, just looking at this, and it's a good example, you can see here the peak of 3 to the peak of what I think is 5. It diverged, and this is very important to remember about divergence. This can go on for a very long time. So this peak was in October 22, and the next peak was October 23. So that's a whole year of divergence before the market started coming off. So that's why you don't, just when something looks like it's diverging, you don't necessarily want to jump in straight away. But it is just a warning sign, and this is long term. Okay, like I said, this took a year to play out. But, we've got that now. So for me, it's just more about seeing if the market can now get below this 40 level, because what we can see here is that we had a whole cycle that ran through here that took, was this January 23 and most of the year. So that cycle now is almost certainly over, and down we come in yield. So, we've broken through this, which is, 4.4, round about that. I mean, just technically that's a good area. And now, of course, the next point of call would just be where we consolidated at the bottom here. But that's quite a long way to fall. I mean, we're talking about rates down to 3.5%. That's a long way down. So I would suggest that rate cuts would probably have to start before we'd be able to challenge this. But of course, rate cuts haven't started yet. Okay, so it is still all just conjecture. We don't know. All we're doing is reading the Fed speak and thinking, well, yeah, that they are talking a lot more dovishly than they were a few months ago. But the market, remember, doesn't like pricing no movement. It'll either rush to price a hike or rush to price a cut. So closer on the daily, and you can see how the RSI warned us here. And like I said, we got this divergence between here and here. And you could probably subdivide this up as maybe that was 3, 4, and that was 5. But we got that divergence and we busted through 40. So now the next point of call on this daily is just watching to see if and when this bounces. And you can see where the RSI is. We're pretty low here. So that sort of makes me a bit suspect that we're maybe close to a bit of a correction. But whenever this starts to rally back up again, and I think it will at some point. I don't see it just going straight down like that. I think, markets don't do too much straight lining unless you're talking about Bitcoin maybe, but, some sort of movement back up just to correct this whole thing. And like I said, once again, I don't know that this is going to be the short-term bottom. We just have to wait and see. But like I said, as I'm making this video in the middle of the day on my what's today, Wednesday, the market, the futures in Asia just look like they're just starting to struggle a little bit as they've lapped into the highs a few times. So that could all get blown out of the water tonight, of course. But the point remains, now just we want to see whatever rally happens here, we just want the RSI to stop below 60. Okay, that would just suggest that the bearish momentum that we've got here can just be maintained. Now, this is pretty steep sort of trend, but you can see it in the naked eye. It's just trending, and you can just see here that looks pretty juicy just on a short-term basis. These tops are obviously going to be important areas. So there's quite a few hurdles before we can get down and really test down to this sort of bottom area here. So that would be how I'd look at that. So I think I'll just leave it there for this video. I don't want to just pour over all the rates. I mean, there's a lot of other things going on in terms of the 10s yield curve, and the way that that's starting to steepen, even though it does bounce around. And obviously the 2-year notes are falling away pretty quickly. I will just bring up one quick thing to finish here. And I just knock this up very quickly. This is the old Eurodollar contract. So it's just one way of gauging how the market's pricing rates. So I've just inverted everything. So you can see as we sit here, we know where the cash rate is, around here in the States, but this just shows how the contracts, how they're starting to price in cuts. Okay, and you can see how much that curve bottoms out. I mean, I'm not saying that, in December next year we're going to be at 3.4%. These change. But as we sit here and now today, that is just how the market is just pricing in those rate cuts to come. Now, yes, of course, it's important for the 30-year bond, but of course this affects the front end of the curve more. However, this is just confirmation that the market is expecting cuts to start probably sooner than what the Fed are currently putting out there. So that's it. If we get a bit more traction with these sort of videos, I mean, they haven't really garnered a lot of interest in the past, but the rate market is very interesting at the moment. It's just, we're at that sort of point where it feels like the tide has turned and we're on the way. So, don't forget to hit like and subscribe on the video. If I get traction, I'll do more, but if I don't, then I won't bother. So thank you very much for watching. Don't forget to hit like and subscribe, and we'll see you next time. Bye for now.